Now let's dive into the economic data, the real engine behind Fed decisions. And this past quarter, the headline number grabbed attention fast. US GDP contracted by 0.3% in the first quarter of 2025. That's right, the US economy shrank for the first time in 3 years, and many headlines ran with this, warning of a slowdown or even a looming recession. But there's more beneath the surface. This contraction wasn't driven by collapsing consumer demand. Instead, it was largely caused by a sharp spike in imports. Here's what happened. Businesses were front-loading, meaning they rushed to import goods ahead of expected tariff hikes. That flooded the trade balance with short-term imports, making GDP look worse than it actually was. So what happens when you strip that out? You'll find that domestic demand was still strong. Services spending held up. Non-durable goods continued to see steady growth. It was only durable goods like appliances or cars that showed a meaningful dip. The inventory buildup also offset some of the damage from net exports. So while the headline figure was negative, the core economic trend remained relatively stable. Now let's look at inflation and labor costs. Two things the Fed watches like a hawk. The quarterly PCE inflation and the employment cost index both surprised to the upside. That means, despite economic softness, inflationary pressure hasn't cooled off yet. In fact, the cost of core services began rising again in late March. That's a red flag for the Fed because it suggests that sticky inflation is not going away quietly. So here's the big takeaway. GDP may have dipped, but the underlying data tells a much more complicated story. Demand is steady, inflation remains sticky, and that gives Powell and the Fed reason to hold rates steady. Not to panic, not yet.